Welcome back to Talk Tickers, the show where we cut right through the noise of earnings season. Today, we are all over UPS. They just dropped their Q4 2025 numbers, but you know what? The real story here is their outlook for 2026. It is truly shaping up to be a make or break year, and we're about to unpack exactly what that means for the stock.
Okay, here's the game plan. We're going to start with a quick snapshot of the results. Then we're diving deep into their huge quality over quantity strategy. After that, we'll look at the all-important 2026 guidance, see how the market is digesting all this, and then we'll wrap it up with our official rating in the next call. Let's do this.
All right, first up, the results. You gotta remember, they're operating in a pretty tough environment. Demand has been soft, but the big headline here is simple. UPS delivered a really solid beat. Let's get into the numbers.
Starting with the bottom line, which is where a lot of the magic happened. Adjusted earnings per share came in at $2.38. Now, Wall Street was looking for $2.20, so that is a clean 18-cent beat, a really decisive win on earnings, right out of the gate. The top line also came in hot. Revenue hit $24.5 billion. That's a full $500 million more than anyone expected. But, and this is a really key piece of context, that number is still down about 3.2% from last year. And that really tells you everything about the tough macro environment they're navigating.
So how in the world did they pull off that beat if sales were down? Well, it wasn't about shipping more packages. In fact, total volume was down. It was all about shipping better, more profitable packages. U.S. domestic revenue per piece was up a whopping 8.3%. And look at this. They hit record penetration with small and medium-sized businesses. This is that quality over quantity theme in action. And that brings us right to the heart of the story here, which is this massive strategic pivot. You have to understand, this is a painful but completely deliberate move away from just chasing package volume at any cost.
Yeah, the CEO, Carol Tomé, she was crystal clear on the call. She framed it as being about differentiated value and boosting long-term profitability. And reading between the lines here is pretty easy. They are more than willing to take a hit right now for what they believe is going to be a much stronger, more profitable company down the road. This slide just lays it out perfectly. The old UPS, it was all about volume, 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 even if it meant taking on tons of low-margin e-commerce stuff. The new UPS is all about what they're calling revenue quality. Now that's just corporate speak for better pricing and really prioritizing those much more profitable small business and B2B customers. And the absolute centerpiece of this entire strategy is something they call the Amazon glide down. They are literally methodically walking away from their biggest customer. They cut 1 million packages a day in 2025, and they plan to do it again in 2026. I mean, just think about that for a second. This isn't just about losing some volume. It forces them to completely re-engineer their entire network for a totally different kind of business. The sheer scale of this whole thing is just staggering. Just look at these numbers. A $3 billion cost savings target. 93 facilities shut down. An entire fleet of MD-11 cargo jets is being retired. Oh, and up to 30,000 job reductions. Folks, this is not just tweaking the model. This is a fundamental ground-up reshaping of the entire company. Okay, let's talk guidance. How does all this pain and restructuring translate into their outlook for 2026? Well, management is calling it an inflection point, but they also used an analogy that I think is perfect, the bathtub effect. So for the full year 2026, here are the headline numbers they've put out there. Revenue, just under $90 billion, an adjusted operating margin of around 9.6%, and EPS to be about flat with 2025. But I want you to file away that last number, $5.4 billion in dividends payments. Trust me, we'll be coming back to that one. The CEO herself called it a bathtub effect, and this timeline shows you exactly why. The first half of 2026, well, that's the bottom of the tub. Revenue is actually declining. All those transition costs are hitting the books, and margins are under serious pressure. Then, June is circled on the calendar as the inflection point. That's when the Amazon glide down is finally done. And in the second half, they expect revenue to start growing again as those big cost savings kick in and margins finally start to expand. It is truly a tale of two halves. So you've got this story, short-term pain for long-term gain. How did the market react? Well, the reaction was, let's just say it was very telling. It revealed a pretty deep conflict in how investors are feeling right now. At first, the stock shot up over 4%. For a few hours, it really seemed like the market absolutely loved the strategy. But then it just faded. All day long, it ended up closing almost completely flat. This spike and fade pattern tells you everything you need to know about the market's conflict with this story.
What that fade really signals is some deep-seated skepticism. The market wants to believe in this turnaround story, it really does, but it has some major questions about whether management can actually pull it off. And a big reason for that fear is the dividend. Remember that $5.4 billion number? Well, they're guiding to only about $6.5 billion in free cash flow. That is an incredibly tight dividend coverage that leaves them almost zero room for error. So all of that brings us to our final take, the next call. And for this one, we're going to frame it up just like we're making a pitch to an investment committee.
So with this incredibly challenging setup, what's the call? From here, is UPS an outperform or is it an underperform? You can really boil this entire debate down to what you see right here. The bull case is that this disciplined pivot to revenue quality is brilliant, and it's going to unlock huge long-term value. The bear case is that this whole shrinking to grow idea is just packed with execution risk, and that tight dividend coverage is a massive red flag for their cash flow.
So here's our prediction. We think this stock is going to be stuck. It's going to trade sideways in a range for most of the first half of 2026. The market is squarely in wait-and-see mode. It's going to wait for cold hard proof that the second half margin expansion is for real before it makes any kind of decisive move. And for that very reason, our rating is market perform. Look, the potential upside from a successful turnaround is absolutely there. You can see it. But right now, it is completely balanced out by the very significant, very real near-term risks to execution and that fragile cash flow situation. But we're going to leave you with our outrageous but plausible trade idea. If you believe like we do that the Q2 earnings call is the real make-or-break moment, the point where they either confirm the turnaround or the whole story collapses, then the trade isn't to pick a direction. The trade is to bet on a big move. You could look at buying straddles, an option strategy that profits from a huge stock price swing in either direction, up or down, after those Q2 numbers come out.
So there you have it. That's the story on UPS, a company right in the middle of a massive, painful, but potentially brilliant pivot. The next 6 months are all about one thing: execution. Can they navigate the bottom of that bathtub and emerge stronger on the other side? The jury is still out, and we will be watching very, very closely. And of course, a final reminder, this is not financial advice.